Welcome to this week's edition of Macro and Flows from Orestes Capital for the week ending on July 3, 2026. We're Elena and Marcus.
And for this week's briefing, our mission is to dissect what I'd call a highly perilous dichotomy that is currently fracturing the global markets.
Precisely, because when you survey the landscape right now, everyday retail investors are effectively sprinting into a burning building.
They're desperately trying to grab heavily concentrated semiconductor stocks.
But what they do not see, what the surface data completely hides, is that the institutional smart money, the funds with the deepest pockets, are quietly and systematically sneaking out the fire escapes.
It's a massive behavioral divergence, Elena. We are observing a structural macroeconomic deceleration that is just colliding head-on with an environment of absolute retail euphoria.
So we are going to look past the superficial narratives. We will examine the hidden plumbing of the market, and we will detail exactly what the OCM house view signals for your portfolio in the week ahead.
To understand why institutional capital is acting so defensively, you really have to start with the actual macroeconomic weather.
Yes, and Marcus, you and I were reviewing the OCM PCA model this morning.
We were.
And if an investor just glances at the financial headlines, well, the prevailing narrative is screaming about a never-ending artificial intelligence boom.
Correct. But our proprietary modeling is signaling something completely different.
Completely different. So for those tracking the data with us, I want you to think of the OCM PCA model, which stands for Principal Component Analysis. Think of it like a highly advanced meteorological radar.
I think that's the best way to conceptualize it. On any given trading day, the markets experience these massive gusts of wind.
Right, the unpredictable earnings misses, the geopolitical noise, daily headlines.
Exactly. And if you trade on the wind, you just get whipped around and you bleed capital. What PCA does is it mathematically filters out all of that daily gusting.
It tracks the massive high and low pressure systems.
The principal components.
Yes, the primary engines that are actually driving asset prices over time. And right now, that radar is showing a definitive, undeniable shift.
When we look at our primary 5-year window, the macroeconomic environment has definitively cooled. We have officially moved out of the euphoria regime and transitioned into a normal to reflation regime.
Let's look at the specific vectors driving that transition. Our first principal component, PC1, which measures global growth, it has shifted down from a peak score of positive 1.07 exits in early June,
which we categorize as peak euphoria.
Correct. It shifted down to a normal state of positive 0.82 sets.
So if I am an individual investor, I'm looking at my screen, I see technology stocks hitting all-time highs every day. I hear you saying our PCA model shows deceleration, and my immediate thought is, well, your radar must be broken.
It's exactly the pushback we get.
I mean, how are we not just fighting the tape here? What does that positive 0.822 Zats actually mean in practice for my portfolio?
It is a vital distinction, Marcus. You have to separate absolute level from velocity.
The market is still growing.
That is the positive 0.82 cents. But the momentum of that growth is objectively decelerating.
And we track this through the weekly impulse delta, which measures the immediate rate of change.
Precisely. That impulse delta cooled sharply to positive 0.28 this week. The forward momentum is fading out.
And we are seeing a similar deceleration in the second principal component, PC2.
Which tracks the rates level and the broader reflationary impulse.
Yes, that component is actively moderating. We tracked a steady decline from the hotter positive 0.66 cease levels that we saw in early June down to positive 0.32 zins this week.
And what is truly fascinating there is the geographic source of that remaining strength.
It's not domestic.
No. The upward pressure keeping PC2 in positive territory is heavily driven by international yields, specifically German 10-year yields, which contributed a positive 192 to the model.
Alongside U.S. 10-year yields, yes. But the domestic engine alone is just not sustaining the heat.
So if the mathematical reality is that growth is actively decelerating, why hasn't the market corrected?
To answer that, we have to look at the participants. We need to examine exactly who is moving the money, because the consensus across the street completely misses the structural shift happening underneath the indices.
When we look at the market intelligence regarding institutional fast money, the fundamental hedge funds, they are exhibiting extreme caution.
They are actively rejecting the mainstream media narrative.
Completely. U.S. long-short net leverage has plummeted to 51%.
And to contextualize that for your portfolio risk, 51% sits at the 6th percentile on a one-year look back.
The smart money is aggressively taking chicks off the table.
And they aren't just trimming their positions broadly. They are aggressively dumping information technology and semiconductors.
Our intelligence captures a negative 2.7 standard deviation sell-off in these specific sectors.
In institutional finance, a negative 2.7 standard deviation move is not a simple portfolio rotation.
No, that is a liquidation event.
But here's the severe vulnerability. You have to contrast that massive institutional de-risking with retail investor behavior.
The retail flows are displaying absolute euphoria, and they are dangerously concentrated.
Everyday investors are pouring their capital directly into memory and semiconductors.
They are acting as the primary counterparty to the institutional selling. Look at the specific massive retail inflows. Micron saw a positive 3.7 inflow,
which represents over $897 million in retail capital allocated in just a few sessions.
And SanDisk hit a positive 4.66 inflow. Retail capital is aggressively buying the exact assets the fundamental hedge funds are aggressively unloading.
So logically, if institutional money is selling and retail is buying, they should naturally cancel each other out.
But the market hasn't tanked yet.
Because there's a third massive participant keeping this structure elevated, the systematic cohort.
We are talking about commodity trading advisors, or CTAs, and systematic volatility control funds.
These are entirely emotionless, computer-driven trend followers.
They do not read the news, they do not debate fundamental valuations, and they do not care that growth is decelerating.
They follow pure mathematical momentum signals.
They blindly buy when a trend is moving up.
And they systematically sell when that trend breaks. Currently, CTAs have inched their equity exposure up to the 64th percentile.
Meanwhile, volatility control funds, which are algorithms programmed to automatically increase leverage when market volatility drops, they have pushed their equity allocations up to the 70th percentile.
This brings us right back to our opening analogy. You have everyday retail investors sprinting into a burning building, attempting to catch falling knives in the semiconductor space.
Meanwhile, institutional fundamental capital is quietly securing the fire exits, locking in their gains, and drastically reducing their net exposure.
And the systematic algorithms are just blindly holding the front door open. They are providing a steady bid simply because their long-term mathematical momentum signals have not officially broken yet.
The critical question you must ask yourself is, who is really driving the bus right now?
Because when those systematic trend signals break, the algorithms will pivot from buying to selling in milliseconds.
And the retail cohort will be left entirely alone, holding the bag.
That transition is precisely the systemic risk we are monitoring. But this massive divergence in investor behavior is not happening in a vacuum.
No, it is occurring against a very specific macroeconomic backdrop that is subtly altering everyday market liquidity.
If we return to our OCM factor trends, our third principal component, PC3, which tracks economic surprise, currently shows no statistically significant trend.
Which is an incredibly revealing data point. It indicates that the economic data prints coming in are perfectly matching what the market has already priced into asset valuations.
There are no positive shocks left to organically propel the market higher. Everything is already priced in.
Furthermore, we are observing a fascinating structural disagreement within our internal models regarding the time frame of this macro regime.
As we established, the primary 5-year model flags a solid reflation regime for PC2.
But our tighter 3-year robustness window strongly disagrees. The 3-year model classifies the current environment as Goldilocks, registering a z-score of negative 0.13.
So what does that model conflict actually mean for your portfolio?
The market is currently attempting a highly complex, delicate transition. It is trying to move from a macroeconomic world that was recently panicked by sticky inflation and rising rates into a benign, growth without inflation state.
That is the Goldilocks scenario. And the belief that this soft landing is achievable is currently providing a temporary psychological cushion for equity indices.
It explains why certain risk assets remain stubbornly resilient, even as the fast money pulls back.
But hoping for a soft landing and executing one are entirely different things.
Very different.
With the macro backdrop attempting this delicate transition, the structural mechanics of the market, the hidden plumbing, become the absolute critical factor.
This plumbing dictates whether a routine sell-off becomes a violent crash. And this is where you must understand the concept of dealer gamma.
We do not need to dive into the abstract mathematics of options pricing.
No, just think of Wall Street options dealers as middlemen who must constantly hedge their trading books to remain market neutral.
Depending on the environment, they act either as market shock absorbers or market amplifiers.
When aggregate dealer gamma is positive, These dealers are mathematically forced to buy the dips and sell the rips to balance their books.
In this state, they act as shock absorbers. If the market drops, they buy, which artificially steadies the market and suppresses volatility.
But when that gamma positioning flips into negative territory, the math reverses.
They become amplifiers.
Correct. They are forced to sell futures into a falling market to hedge their exposure, which rapidly speeds up the decline.
This hidden mechanism dictates the speed and severity of drawdowns, directly impacting the value of your portfolio. And that hidden plumbing extends directly into the credit markets.
When we analyze the market intelligence regarding high-yield credit, the surface looks flawless. It is priced for absolute perfection.
The CDX high-yield spread currently sits at a razor-thin 302.1 basis points.
The spread compression is severe across the board, from double B down to triple C paper. Everyone is aggressively reaching for yield.
However, the underlying plumbing beneath that pristine surface is flashing red. The CDX high-yield 3S5's curve spread, the difference in yield between 3-year and 5-year debt, that has widened out to the 81st percentile.
Marcus, why should a retail investor who is primarily focused on their equity portfolio care about the intricacies of the 3S5's curve spread in corporate credit?
It's a crucial question.
Whether we are analyzing corporate bonds, CLO tranches, or CMBS structures, why does this specific metric matter?
Because credit markets always sniff out systemic stress and liquidity issues long before equity markets do. It is a leading convexity indicator.
Think of it as discovering a structural crack in the foundation of a house long before the damage becomes visible in the living room upstairs.
Exactly. When the 3-year yield spikes relative to the 5-year, it tells us that corporations facing immediate refinancing are struggling to find liquidity.
The market is demanding a massive premium for near-term risk.
So when the 3S5's curve widens to the 81st percentile, the credit market is quietly pricing in near-term default risk and liquidity constraints.
Despite those headline spreads looking incredibly healthy.
Furthermore, we are seeing confirmation of this exact stress in the safe haven derivative markets. Gold's 3-month put-call skew has spiked significantly.
A spike in gold's put-call skew demonstrates a desperate, price-insensitive demand from institutional investors for downside tail hedging.
The smart money is aggressively buying expensive insurance against a systemic shock, all while the broader equity market looks perfectly pristine.
This brings us to the ultimate execution of this data, which we refer to as the pain trade.
We have established the cooling macro regime through the OCM PCA model.
We have documented the massive divergence between retail hoarding and institutional offloading.
And we have identified the fragile state of market plumbing via credit spreads and negative dealer gamma risks.
The primary squeeze risk right now is incredibly severe. The divergence between retail aggressively buying technology and institutional fast money dumping those same assets creates a massive structural vulnerability.
We are seeing market breadth severely contracting. If you look at the NASDAQ 100 versus the equal weight NASDAQ, the equal weight index is showing a severe negative 6% drawdown.
The market's rally is narrowing down to a dangerously small handful of names, and the crowding is historically extreme.
The consensus across the street shows that momentum exposure currently makes up roughly 60% of prime book fund equity.
The market is leaning entirely on one side of the boat. If this crowded momentum trade begins to unwind, the negative dealer gamma we discussed will act as a vicious amplifier,
turning a standard correction into a forced liquidation event. Therefore, we must outline the actionable OCM house view strategy for your portfolio in the week ahead based on these structural realities.
Despite the risks, the base macro regime remains normal to reflationary. You should maintain a pro-cyclical bias, but you must shift your execution.
We're leaning heavily into emerging market equities. This includes strategic allocations into specific Asian indices like the KOSPI.
We also favor copper, capitalizing on the underlying industrial growth theme rather than energy.
Energy is far more vulnerable to the growth deceleration we are tracking. On the fixed income side, you should maintain your exposure to credit yield, but absolutely avoid small cap equity allocations.
Historically, our proprietary modeling proves that small caps bleed capital in this specific decelerating macro regime.
They struggle immensely with refinancing their heavy debt loads at sustained higher rates, which ties directly back to the stress we are seeing in the 3S5's curve.
Finally, keep your portfolio duration neutral. We recommend utilizing the 10-year and 2-year treasuries strictly for portfolio balance and volatility dampening.
Not for aggressive directional bets. Before we conclude this briefing, There was a final provocative thought you should mull over in the week ahead.
We are watching retail investors consistently step in to buy the dip, effectively acting as the exit liquidity for institutional algorithms and hedge funds in these high-flying technology names.
Does this dynamic permanently alter the structure of market tops?
Are we truly witnessing a democratization of finance where the everyday investor has unprecedented access to wealth generation?
Or are we simply facilitating a highly efficient, algorithmic mechanism for wealth transfer from the retail public directly to institutional players?
See you next week, wherever the flows take us.